Good afternoon, everyone. I am Kathy Neifeld, one of the four principals at Agency One. Along with my partners, Ed Lesher, Dennis Bartos, and Gonzalo Garcia, we are pleased to welcome everyone to the seventh installment of Agency One's 2021 bi-weekly webinar series. Since the beginning of the year, we have had webinars on estate, income, and gift tax planning, and asset protection under the new Democratic administration, featuring attorney Alan Brown and advanced markets consultant Randy Zipsey. A webinar on changes to the Internal Revenue Code section 7702 and the impact that these changes will likely have on permanent life insurance products with Bobby Samuelson. A webinar on digital marketing tools, resources, and strategies that you should be using to help drive more business with Samantha Russell, a webinar on premium financing with US Bank and Taylor Miller, an underwriting webinar featuring our very own Dennis Bartos, Jessica Karakoff, and Julie Melendez, and an economic update with economist Aniban Basu. All of these webinars, with the exception of the one on section 7702 featuring Bobby Samuelson, have been recorded and can be accessed by you on the Agency One YouTube channel and also on the Agency One website for your convenience. For those of you that are new to Agency One, a brief introduction. We are a very high-touch exclusive BGA. Exclusive, what does that mean? We have a platform called the Agency One 100, and one of our guiding principles is to work with a small, select group of advisors in a very large way. The advisors that are part of this group are like-minded, highly successful, creative, and driven. We focus on life insurance and fixed annuities. If you have other needs like disability insurance or life settlements or standalone long-term care, we have strategic relationships with the best providers in the industry to refer you to. We truly have the premier underwriting department in the industry, led by my partner, Dennis Bartos, and advanced markets and case design departments led by my partner, Gonzalo Garcia. If you want high touch, personalized attention, advocacy, and want to feel like you and your cases are important, then Agency One is or should be your BGA. If you would like to learn more about us, the Agency One 100 platform, and how you can become a part of it, or if you have a case that you would like to discuss, please reach out to me or Gonzalo or Dennis or Ed. I have some important additional announcements about what Agency One has planned for the next few weeks, and I will be sharing them with you at the end of the webinar. Now on to today's webinar, the current state of the industry with John Hancock, Brooks Tingle. Agency One is very excited and grateful to be again hosting Brooks for the next 45 minutes or so. And this session is sure to provide tremendous insight as to what is happening in our industry from one of the most well-respected leaders in our field. Brooks is going to be joined by my partner Gonzalo, and they're going to cover a variety of subjects, including a 2020 review, what we can expect in 2021 regarding challenges that the industry continues to face, as well as opportunities on the horizon, specialty platforms offered exclusively from John Hancock and how they are faring, underwriting, and many more subjects. Brooks will try to respond to any questions that have been asked at the end of the presentation, so please submit your questions through the question or chat feature at the bottom of your screen, and we will be monitoring them as they are submitted. This session is being recorded. I now have the privilege and pleasure to turn this session over to both Brooks and Gonzalo. Thank you.
Good afternoon, everybody. And Brooks, good afternoon to you. Thanks for joining us again. I think it was May 1st last time we had this opportunity to do an interview like this. So I'm really excited, but you know, it's almost been 11 months, or I think 11 months tomorrow, and oh, how the world has changed, right? I mean, we were at the beginning of COVID, maybe 6 weeks or 7 weeks into COVID, and we were all scratching our head wondering what the heck was going to happen with the insurance industry. So let's take a quick look back at 2020 and, kind of what your just kind of big picture thoughts are relative to 2020. And then I'll ask you about, kind of how to go for John Hancock.
Sure. Well, thanks for having me, Gonzalo and Kathy and everyone. I have enormous respect for what you do at Agency One, and I can't tell you how much I enjoy these opportunities to speak with you and your associates. It's funny you say how much has changed, but I'm struck by how much hasn't changed in ways. Like I'm sitting in the exact same spot, looking at the same scene, not having put a jacket on in a long time, or a blazer at least, and not having been on an airplane. And I don't know, it's like there is a sameness to it as well. It's been, it's hard to say anything's unprecedented these days, but it certainly has been an unprecedented year. I think 2020 was a year of highs and lows, right? I mean, you can't talk about 2020 and not acknowledge the great human tragedy and suffering of 550,000 plus Americans having passed away, and the direct impact of that on their loved ones and family members, but so many other stories. I mean, virtually everyone has been affected, and the impact on kids and working parents it's been just something. So I'm going to talk about some opportunities arising from COVID, but I want to start by acknowledging just the great human tragedy that it's been, and hopefully there's light at the end of the tunnel here. Maybe we'll talk about that. But so many lows in that regard. The highs, I would say, for John Hancock and for our industry is that we've proven again the things that are very special about this industry: resilience, financial strength. Certainly, there's nothing like a global pandemic with hundreds of thousands of Americans dying sort of almost from something out of the blue to reinforce the value of life insurance. Yep. And as a result, we saw demand for life insurance go up very sharply, but because it's been a year of highs and lows, that created its own problems. We frankly didn't deliver the kind of service that I would like to in new business and underwriting last year because we were awash in apps and a lot of term apps as well. So it was a year of ups and downs. I think it all sort of netted out to a better year than I expected for us as a company sales-wise. And I'm just so proud of and impressed by the resilience that you and your colleagues have shown, and continuing to figure out ways to serve the important needs of your clients. So certainly some important highs. And I think, coming into this year, real optimism. I guess that's the word I would say is where I'm coming from now. Optimism, hopefully, that we're moving beyond COVID, hopefully. And optimism for our industry. COVID has proven to be a tremendous proof point for the value of what you guys do, what we do as a carrier. And I think I've gone from sort of trying to figure it all out this time, last year when we spoke, to real optimism looking forward.
Yeah. And it's thank you for that kind of intro. And then, we can't have events like this without thinking about all the terrible devastation and all the things that have happened to so many people and so many families. But, you brought up some of the challenges because our industry was there was such an onslaught of, alertness or awareness around insurance. You brought up service issues, and I didn't want to really dwell on this at all, but you're not alone, right? And there were a lot of companies that had those challenges. What I want to focus on, though, is, it should have been a really good year for a lot of companies. I think you guys did very well. There's a lot of companies that did well. And there were some that were not winners. I mean, there were some big winners and losers here. And, we're going to get into some of the headwinds here, but just kind of, again, thinking about winners and losers in the business, there's been a lot of press lately of people getting out of the business, getting out of product lines, being bought, just getting out of insurance altogether. And there's a lot of pressures, and we're going to talk about those a little bit more, but, just kind of big picture comment on the winners and losers conversation, because I think that's important to talk about.
Yeah, I started by saying I'm very optimistic. I'm an optimist by nature, but there's no sugarcoating the fact that these historically low interest rates and the duration of these low rates. And frankly, even though there's been some uptick the past, 45, 60 days in the 20-year note and things like that, it's difficult to imagine any sort of sustained interest rate increase anytime on the horizon, just given the massive amount of government debt and the consequences of it. So anyways, I don't want to sugarcoat the fact that these low interest rates are tough on our industry. Now, when you think about, I'm reluctant to characterize winners and losers, but I would say that for Hancock, we were fortunate to sort of have had to deal with the reality of these low rates, gosh, 10 years ago.
Yeah.
Almost coming out of the last financial crisis. I think most folks know that we're owned by a Canadian parent, have operated under a Canadian accounting regime, which I won't bore you with the details of, but it's basically sort of mark-to-market accounting. So you have to deal with the economic realities of today, and project that they don't change in the future. So it really necessitated a lot of innovation on our part, clever product design on less interest rate sensitive products, innovation around things like vitality and so forth. So in a lot of ways, we were better positioned for this because we had sort of largely acclimatized to this low interest rate environment. So when the economic realities post-COVID hit, we saw a bunch of competitors having to scale back pretty dramatically, limiting products, raising rates, things like that. And we've not been fully immune to it. We've had to take a couple tough actions that they're just tough, but more than anything else, we've been leaning into it. We've been in a position, and we may talk about it, but we've just actually strengthened guarantees, on our VUL product. So we see opportunity. And one of my favorite things as a leader is when others around you are sort of pulling back or tightening up or retrenching, is lean into the opportunity.
Yeah.
And, but I'd say the fundamental reality is interest rates are tough. We're not immune, but better positioned than most.
Would you call the interest rate environment I hate to use the word existential crisis, but for some carriers it has been. I mean, for some carriers, this environment has just literally put them out of business or completely eradicated certain product lines. I mean, would you think if a prolonged a period of this is going to continue to deteriorate some of the availability of insurance or products that we're selling today?
I don't think it needs to. I think it's like anything, right? When tough conditions emerge, some people innovate and evolve, and some people withdraw. And I don't judge the folks that have chosen to withdraw, but we had sort of a head start on this, and our response is we see massive opportunity, and let's lean into it. And yes, there are challenges, but I think if you look at our product portfolio today, we're extremely happy selling every product on our shelf right now. It's not like we're sitting here saying, oh gosh, is this sustainable? We're completely comfortable selling every product on the shelf. So that kind of shows that you can offer good consumer value, good value to the distributor, and feel good about it as a carrier. So it's not an impossible thing.
Right. I remember being at a forum meeting in January, I don't know, it was 6 or 7 years ago when Protection UL came out. Mm-hmm. And, everybody was selling GUL at the time, and you guys went left when everybody was going right. In retrospect, knowing what you know today, that was a really smart decision. And that product had some uniqueness around it in terms of the investment portfolio that supports it and some other things. Can you talk a little bit about that? Because I think that's a real timely subject, especially in today's environment, and kind of where you guys have differentiated that product in the market to be the bellwether of the UL space as it is.
Yeah, it was important to us then. And by the way, part of that was born of necessity. The low interest rates that really started over a decade ago hurt us badly. So we had to move to a less interest sensitive portfolio. But it wasn't just to that. It was also a conviction we have about customer value. Mm-hmm. And I really, truly believe, in the policies I buy for myself and what I talk to friends and family about, that, full lifetime guarantees, they're for some people, that's fine, but they come at a heavy cost. And we've always sort of believed that there's an optimal trade-off there of good, strong guarantees, but also a lower price point, also some nice cash. And we've been trying to kind of optimize that blend. And, Protection UL was our first foray into that. You've seen us continue to evolve though with, we've got into the IUL space, have done some good work there. And now with our Protection VUL, it's really gratifying to be able to sort of go in a little bit of a different direction, which is actually now extend guarantees to age 100 on a product. Again, just trying to kind of find that optimal, value point for customers. So yeah, we're proud of the innovation. We've had a lot of years of trying to refine those types of product designs to optimize the value to the customer, to the distributor, and you can expect that to continue.
Great, great. Well, let's talk about one thing that was an interesting move, and it was New York, right? So there was a pretty big pull out of New York. You still have a few products there. I can guess what prompted it. I mean, can you just, I know I had a lot of questions from people. It's like, what's going on in New York? So you want to just kind of, from your perspective and maybe from an industry perspective.
Sure. So first, I want to be completely clear. We're not exiting New York. We have a New York subsidiary. We're not withdrawing. We're not giving up our license. We're committed to the New York market. I would say that there are realities of doing business in New York now, that the practical consequence of which was that every single time we bring a product to market, we build two versions of it.
Mm-hmm.
We build two versions of Vitality, one for every state but New York, one for the state of New York. Two versions of every single product you see on our shelf, non-New York, New York. There are some reserving requirements in New York that made certain of the products on our shelf really, really not. I mentioned, I have to feel really good for our shareholders that everything we offer on our shelf. I don't want to be like saying, hey, Gonzalo, can you try not to sell so much of this? Like, if we have it on the shelf, I want you guys to feel confident selling the daylights out of it and know that we're not going to be having to yank it or do something down the road. So it's an important market to us. We still serve hundreds of thousands of customers there. We still have products on the shelf there. We want to be able to provide people that bought term policies from us there, good conversion options. It is not I expect it not to be a permanent situation. I think as conditions evolve, frankly, for us, it was really a matter of focus and priority. We have some incredible opportunities right now. I generally can't talk about, but some really exciting things that we need to invest in to drive some really exciting growth we have on the horizon. And it just in the range of priorities in terms of building two versions of every product, you just said, you know what, let's narrow our shelf in New York for a while. But I would, again, we're not pulling out. It's an important market for us. I have a great deal of respect for the regulators there. It's probably not a regulator that I've met with more often in person than the folks in New York. And there's no malice there. It's just a practical reality. And I think folks should expect us to, we've shrunk our shelf a bit there. Sure, the time will come where we expand that shelf again.
Right. And kind of speaking of New York, kind of the whole best interest movement started with Reg 187 and, is now in Iowa, and there's, more and more states rolling it out, and both on the annuity and life side. How do you see the best interest or Reg BI and kind of everything that's happening around best interest impacting? We're kind of talking a little bit about headwinds here. We're going to get into some opportunities, but again, as a headwind, do you see challenges with Reg BI and what happened in New York and what's happening in other states?
Yeah, gosh, it's so often, I don't want to get into anything that smells of politics, but it seems so often the case where regulations that are conceived, have a noble intent, right?
Right.
But then by the time it kind of goes through the process and again, the practical reality of you and your team dealing with it and us, it just never seems to quite, I don't want to say hit the mark, but it never quite turns out the way I think probably the original sort of noble aspiration did. I can tell you, I've been in this industry a long time. We're blessed to work with the very best firms and advisors in the industry. And I can't even tell you how many years it's been, decades it's been since I've seen an instance where I was uncomfortable with what I saw an advisor we worked with did. I think that the professionals, the true professionals in our business, associated with Agency One, I just think people operate this way in spirit already. But nonetheless, it's a reality. So there are sort of two levels that I would say we approach this on. One, obviously, we're very active participants in the trade associations, the lobbying groups and so forth to try to influence what these things look like when they do come out. And then the second part is we have people dedicated in our distribution team to figuring out how to help you and help us operationalize these things when they are passed. And we dedicated a lot of resource on Reg 187 to try to minimize the pain from it, I guess is the best way to put it, and fulfill in substantial part, the noble aspiration of it. So that's kind of how we approach it.
Got it. So really no kind of you're not seeing real headwinds there in any way, so, but you're not seeing any reaction that would be required by Hancock or any other insurance company to kind of really, other than investing and paying attention to it and try to do the right thing and make sure that you've got people kind of focused on the right issues. You're not seeing any other additional crises in that particular space.
Crisis, no.
Okay, got it. All right, so I want to talk also a little bit about, we talked a little bit earlier about people getting out of the market. So a little bit of contraction in terms of carriers, some big contraction in terms of product offering.
Mm-hmm.
And do you see anything that's going to really impact more contraction? Maybe some M&A activity, maybe more companies just getting out of business, getting out of the life insurance business? Or do you see this as, with low interest rate environments continue to put pressure on us, regulation, Reg 187s and best interest, and just kind of all the things that are coming at us all at once? Do you see people just throwing their hands up and saying, we're done?
Yeah, I don't. I think they're like everything, their forces going in multiple directions.
Mm-hmm.
But I don't think the net of it all, just as some people see something discouraging and pull back, others see opportunity and lean in. That's just how markets work, right? And where there is strong demand, which there is for our types of solutions, getting stronger, by the way. COVID, we'll probably talk about potential tax reform. I mean, the demand is there. Where the demand is there, where the customer need is there, where the value is there, people are going to fill that space. So I think, yes, you'll see some people probably withdraw a bit. A lot of the transaction activity tends to be more on closed blocks and things like that.
Mm-hmm.
But I think you're going to see others kind of leaning into the market as we're trying to do and say, there's real opportunity here now. Let's meet that opportunity. Yeah.
Well, and I got to tell you, I mean, I'm in spite of all the challenges, I'm highly encouraged. I think our industry's got a long runway and we've got a lot of really great things to continue to do. And so I'm very optimistic. Brooks, I'm going to take a quick sidestep here just because I've had a couple of questions but we talked about protection UL, so I want to get to that again and answer this question. I think I know what the answer is, but we'll let you voice this. It looks like, the comment is about decreasing interest rates and, how it was a massive offering early on. The interest rate was fundamentally higher than the rest of the market that was supported by a little bit of a different portfolio. There have been some market downticks on this product, 4.8, 4.55, now 4.35, and it went from 5.25 when we started 6 years ago. That's a fairly narrow range considering, the massive interest rate drop that we've had. Can you just talk about some of the pressure you're having on protection UL relative to a portfolio and those successive interest rate drops? Because I think that's kind of the spirit of the question. I'm just interpreting it.
Yeah, I would say two things that may sound on opposite sides of it, but they do line up. First of all, having to touch that crediting rate effectively twice last year was a difficult thing to do, not something we take lightly. But at the same time, if you look at the arc of history since we launched that product, and your intro sort of intonated this, that rate has been remarkably stable. If you actually look at what's happened sort of macroeconomic wise since launch in the number of crediting rate moves we've had, I don't want to minimize it because I know those are tough. They're tough for advisors, tough for the client. So I'm not trying to minimize it. Those are tough actions, but the basic investment thesis behind it, the alternative investment strategy and so forth, is actually held up very well. Yeah. I mean, other than, some challenging stretch here on oil and gas, timber and the other alternative things that have been behind that story, private equity, things like that, have held up very, very well. Yeah. So the fundamental story is still strong. Those were tough actions last year. I can tell you, there's not any sort of spread gap there or anything. There's not absent some sort of extraordinary actions, economic developments. We're not sitting here with a problem that we've got to close. We're comfortable with where we are. So I guess I'd say they were painful, but I think the overall story is still very positive. We actually do a lot of modeling where we look and say, if a customer who bought that, say in 2010, had bought GUL instead, even with the change in crediting rate, would they be better off or not? And, if people are interested, I could share some of that modeling, but far more often than not, they're still better off having bought protection UL than had they bought guaranteed UL back then.
Yeah, interesting. Well, look, I want to focus on some opportunities and some other really cool stuff that you guys are doing. So let's, I think we hit all the headwinds and all the challenges, and and I'm sure a lot of people read that stuff in the press as well. We talked a little bit, so let's kind of change over to opportunities. We talked a little bit about renewed interest in life insurance due to COVID. I mean, you guys had a massive spike. The industry had a massive spike in what is generally a pretty flat industry. What did COVID teach us as a profession, as an industry, and you guys as a carrier, that we can continue to capitalize on this heightened awareness around our own mortality?
Yeah, several things. I'll mention a couple. One, fundamentally, people are more aware of their mortality. Demand for life insurance. Limmer published a stat recently. 7 out of 10 people say they're more likely to get life insurance, see the value more than ever. An interesting stat, by the way, that'll sound a little self-serving, but it is a real stat. One of our reinsurers, I think it was SCORE, surveyed U.S. consumers and said, what's one thing you're going to do differently as a result of COVID-19? Coincidentally, 7 in 10, again, 70% of people said exercise more and lose weight, which on the surface of it, you think that's kind of a funny answer. But if you look at COVID outcomes, whether it's this virus or the next virus, there's been sort of a realization, certainly something that's given me pause, that that your baseline health going into some sort of disease like this matters a ton in terms of how well you recover. So increased demand for life insurance, increased desire to be more healthy, exercise more. We think something like Vitality is the perfect solution there. So, but the other things it's taught us, like digital processing, right? Like our industry, our industry is like shamefully behind others in terms of digital and so forth. And we've done some cool things with Vitality to make it more digital, but other parts of the value chain, we need to be accelerated. And COVID had the effect of accelerating some of those investments. You mentioned, we'll probably talk about underwriting, but we have to radically simplify that process from taking an app to getting medical records to, and COVID forced that, right? In an environment where having a paramed come to your home for a while there wasn't a practical thing. We wanted to continue to underwrite, right? We had customers to serve. Going to a doctor for a doctor's visit wasn't practical. So that's one of the positive outcomes from COVID that I would say I'm most excited about, is the forcing of digital investments that we had been making, I think, as an industry, and I know we had at Hancock, but just doubling down on those.
Right, and there was a massive acceleration across the industry. What people had 3-year plans, it became a 6-month plan, and just because they had to get out to market to survive.
And electronic policy delivery, for example, right? With some were doing it, some weren't. It was like there's no other way to deliver a policy for a while, right?
Right. Yeah. So, and I suspect that again, I think that if you look at all the statistics and all the Limmer stuff and all the studies that you read, I mean, one of the big challenges for consumers was they hate the process, right? And the process has been broken for a long time. Technology now is allowing us to get through that process in a much better way, which leads me to another opportunity, because I think that, we talked a little bit about it a bit ago, but all the noise around Biden's tax plan and the infrastructure plan and now higher taxes and how we're going to pay for all this and so on. I mean, there is a lot of new interest in income tax planning, because everybody thinks income taxes are going to go up, and estate tax planning because everybody thinks that we're going to have a lower exemption and higher estate tax. So what are you guys doing as a company to get out ahead of that and help the people on this call, and as a carrier and your advanced markets team, which is second to none? How are we going to get ahead of this and really capitalize on some of these opportunities? What are you guys doing there?
A couple of things. One very intuitive and obvious, and one less so. The intuitive and obvious stuff is, you mentioned our advanced market team led by Carly Brooks. We're just so proud of that group and actively leaning into those planning opportunities. You'll see more and more content coming from there. Product designs that we think facilitate those types of opportunities, continuing to improve the value in our products. The less intuitive thing that we're doing, although you see a lot of focus on it among our trade organizations and so forth, is mitigating what I think is a risk coming out of COVID. We have to reach a larger swath of Americans with life insurance solutions. We have to, because the sad reality, another sad reality coming out of COVID-19 is the vast, vast majority of people dying from COVID-19 did not have life insurance.
Mm-hmm.
And, it's hard to generalize. And we've certainly paid some claims, but I know I've told you this story, Gonzalo. Like I look up on my TV screen and see the number of deaths scrolling by, and you apply your market share and say, oh, we should have this many claims. We never had a fraction of that many claims because so many people didn't have life insurance. So I do worry a little bit that if our industry doesn't do a better job of reaching all Americans, that will be, increasingly accused of sort of serving the rich. And hey, there's nothing wrong with serving the rich, right? Like I'm not taking anything away from that.
Understand.
We all create a ton of value for people. A consumer is a consumer in terms of deserving great products and planning. But I do think there'll be increased scrutiny on that point too. And so I think, lean into the opportunity, the direct planning opportunity with advanced markets, case studies, things like that, products, value, but also sort of at the strategic macro level, make sure our industry's house is in order by serving as broad of a swath of the American public as we can. So the things that make life insurance so attractive in, a higher tax regime aren't threatened.
Yeah, well, I mean, look, everybody wants to go after the estate planning case, the business planning case, the high net worth client. We get it. And our industry is often accused of being a little bit elitist and serving the wealthy because, we hang on the tax issues to get us there. We ignore that part of the market, which is probably one of the reasons why it's grossly underserved. And, but at the same token, you can't make any money doing that. So, the survival of the people on this call relies on the fact that if we're going to serve that space, there has to be technology, there has to be delivery systems, there has to be an investment on the industry's part to get us there. And maybe, the people on this call don't want to be calling somebody to sell a $200,000 10-year term policy. So how do we get to that part of the market? Or how can people on this call actually participate in that, which is more of a direct to consumer, more of a throughput issue than, and then just getting there quick and efficiently, because we can't make money doing it.
You're 100% right. The narrative around why everything's gone up market is, advisors have moved away from it because they can't make money. Well, that's only true because of how hard carriers make it to do things, right? I mean, no advisor can possibly afford to day in and day out shepherd cases through an ugly new business, paper-intensive, time-intensive new business and underwriting process for the commissions that spin off of a modest term policy or something. So it's mostly on the carriers. And, we tried DTC for a while. I can't sell anything, Gonzalo. Like you guys are good at selling things. The people on this meeting are good at selling things. I'm not. We're good at some other things. Like we can underwrite, we can design products, we can't sell. So the answer to this is us coming up with products and processes that are much more turnkey, than partnering with organizations like yours to get the people with the selling skills, the advisory skills to be able to meet more clients that way, but not have to get bogged down. So basically kind of change the economic paradigm some.
Yeah.
And some of it may, it's definitely technology enabled, it's process enabled. We shouldn't be underwriting as much as we do on a lot of these cases. So it's an exciting area of opportunity. It's not going to be solved overnight. Right. I don't think carriers going direct to consumer is really the way. That's a tough game. I think it's going to involve innovative partnerships between us and our great partners like yourself with technology brought to it.
So that kind of takes me right into one of the points I wanted to talk to you about was alternative distribution. So, I've been banging the drums for a while that, a lot of people have moved into the wealth management side of financial services, portfolio construction, advisory services, all that kind of stuff. At the risk sometimes, at the expense sometimes of the risk management conversation. And the two rarely meet, right? So there's the insurance people over here and the wealth management people over there, and neither one of them talks to each other really very often to serve holistically the needs of clients. One of the fastest growing spaces is the RIA, Registered Investment Advisory space. Obviously independent broker dealers. I mean, people are leaving some of these wires and other institutional houses in droves. what is Hancock focused on around distribution? Because it's changing too, and the advisory population's aging. You know, people are less served. There's not enough people to serve the people that need help. So kind of, how are we going to get there?
Well, great point, and what a great area of opportunity. Although I caveat that with, we've been having this discussion for like decades, right, about the opportunity of it.
Yeah.
But I do think it's real now. And first of all, I promise our audience this is not a paid appearance, but I do want to say, you know, Agency One just does a phenomenal job. You know, if there are folks on this call that haven't worked with Agency One much yet, you're with an RIA or something, just the support that Agency One provides that space. I get to see this activity all across the industry, right? And you guys just do a tremendous job supporting that part of the market. And we're grateful for it, because it does represent a huge opportunity for multiple reasons. One is the vast number of trusted customer relationships folks in that space have. They already have these great relationships, know so much about their wealth. But the second part of it is, and I know it's easy for me to say, but I don't think you can have a responsible financial plan. This isn't a new thought, but I don't think you can have a responsible financial plan that doesn't contemplate the risk. You could have the best wealth accumulation plan, but darn, man, if you get sick or you know, heaven forbid, die unexpectedly, it can blow the whole darn thing up. And I'm not throwing stones. It's easy for me to say, but I think it's borderline. I don't want to say irresponsible, but let me put it this way. The people that do contemplate the risk element are doing their jobs the very best. Because if you're working with a customer to give them peace of mind about their financial security for them and their families, you can't just look at the accumulation part. You got to look at the protection part. And that's both the death benefit protection, as well as, you know, long-term care riders and things like that. Because one of those two things, maybe both, are going to happen to all of us. And so there's huge opportunity there. What do we need to do as a carrier? We've got to make, it comes back to something we were just talking about. We've got to make the whole buying process a hell of a lot easier, right? And I get it. If my primary day-to-day activity is rendering financial advice, you know, market-oriented financial advice, I'm not hugely interested in, I may be fine talking to you, Gonzalo, about your wealth and your income and your goals. I don't particularly want to talk to you about the results of your last colonoscopy or what have you, right? Like, it's just, we make it really tough. So we've got to move towards a more transactional buying process, not advice process. We're not looking to do that, but we've got to make it easy. I mean, the old drop a ticket type concept is cliched, like it was, you know, for annuities, and still is to some extent. We've got to take the advisor, not expect them to get their hands so dirty, pardon the bad analogy there, get their hands so dirty in the manufacturing process of the policy. That's through radical simplification of the underwriting process. It's by, you know, and you guys help a lot, right, with these folks, helping them not get so close to that process. But that, I think, is one of the most important things, is just make life insurance acquisition more of a transaction than a several week invasive, awkward set of discussions process.
Yeah, well, and that goes back to a lot of the technology improvements and stuff that we were talking about earlier. You know, look, I think you talk about fiduciary responsibility and you talk about financial wellness. All of that incorporates a lot of things you just talked about, right? It's not just about, you know, the little spin wheel that says you're 92% confident in that you're going to retire with the income that you want, and, you know, at 67 or 72 or whatever it is, because there's so many things that can derail that. And those are the risk side. That's the risk side of the equation. We don't talk enough about that. So I'll get off my soapbox on that one. Let's talk about the vaccine, right? You guys just came out with something really cool on Vitality for people who got vaccinated. You want to talk about that?
Yeah, well, and by the way, Vitality is interesting in that sort of wealth management space too, right? Because if in that space you sell somebody a life insurance policy with Vitality and they engage in their savings, say 10% on their premium, well, what's a good thing to do with that 10% savings? Pour it back into an investment account, because if you're engaging in Vitality, on average, you're going to live a longer life. If you're going to live a longer life, what do you need? More savings. So sort of a virtuous cycle there. But Vitality's been, I mean, again, COVID-19's been just an amazing proof point for Vitality. And, you know, last year, while sales were, you know, sort of, you know, pretty good, but, you know, not stunning with everything going on with COVID, Vitality sales were way up double digits again last year. and this year just off to an incredibly strong start. And just the principle of it, sort of the values behind it, really resonate during COVID. And if you look at what it's given us as a platform in terms of being able to add value to the advisor that offered the product originally, and serving the client and to the client themselves, we've done several things since COVID through the Vitality program to respond to COVID. We sent people face masks. I don't know if you still use yours or not, Gonzalo, but we sent our Vitality customers a face mask. And one of my favorite stories is one of the guys on my team was on vacation last summer, just walking down the street in a beach community, and saw some guy walk by with a John Hancock Vitality mask on. And he didn't recognize him as an employee. And he said, "Hey, do you mind me asking where you got your mask?" And he said, "It's the weirdest thing. I got this thing in the mail, and it was from my life insurance company. And I thought, this is so strange." Then I realized, of course it makes sense. Of all the companies to send me a mask during a pandemic, it should be my life insurance company. Yeah. So, we've done a virtual 5K. We've done that. We've put out a lot of content. We created a new way to get points for in-home workouts for people that used to go to the gym. And now, as you said, people can earn 400 points for getting the vaccine, which we're really excited about, and just gives us another opportunity to add value post-issue.
Yeah, I've got to bring this up because it's just something that made me so angry. There was a bunch of Twitter noise and web noise about people out there saying, insurance companies are not going to pay a claim if you get vaccinated because it's an experimental drug, and if you die and whatever. It was terrible, the fact that was out there. And the ACLI had to respond. And what I was telling people is, look, Hancock's giving you 400 points to get a vaccine. Do you really think they're going to deny a claim? I mean, really? So, it was a bad moment in our industry. I mean, social media being what it is, kind of took it the wrong way. I think it's great that the industry has gotten behind vaccination and continuing to serve consumers during this process. Let's talk a little bit more about Vitality. I mean, you've thrown out some statistics in terms of premium savings to consumers, and you talked a little bit about adoption and what you guys are doing during COVID, but this has been a huge success for you guys and for consumers.
Yeah, and the fun part about it, Gonzalo, and you've been there from the beginning, but the fun part about it is we're over 5 years into it now. Mm-hmm. So we have an increasingly robust set of data and proof points that this isn't just a theory. We can actually show results. Yeah. And there are a couple things I would just say, and I don't want to turn this into a Vitality commercial, but a couple things. One, in these economic conditions, we talked earlier about us having to take a tough action on crediting rates on protection UL. What I love about Vitality from just a product performance perspective is it's a nice hedge against other non-guaranteed factors in your policy you can't control. I illustrated it when I bought policies a couple of years ago. I illustrated it gold, and I've hit platinum. By the way, if I'm hitting platinum, that should tell anybody who's a skeptic how easy it is to hit platinum, because I'm not running any marathons. And Gonzalo occasionally makes me have a beer or something. So anyways, but I hit platinum, and that creates a tailwind in my policy's performance that mitigates some other factor. If my IUL, tranche didn't perform quite the same, or my VUL subaccount didn't return. It's a nice tailwind that I control. Most of us don't have any control over what interest rates are going to do. Right? I control my Vitality status. So I like that from a product design perspective. And actually, we're seeing more and more advisors showing bronze, which creates just upside to the client. Yeah. But anyways, so that's one part of it. But in terms of actual outcomes, it's a little early to have credible mortality data yet. That generally emerges over 10 plus years. The mortality data we have so far is looking very positive, but we have a whole bunch of proof points within the program that indicate really good health outcomes. Half of our customers, you do this Vitality Health Review, half are reporting an improved BMI in the program. A third are reporting lower cholesterol. Our customers take on average twice as many steps. 81% of customers say the program's positively changed their life, impacted their life. By the way, the other 19 said no impact. It's not like the other 19 said it's hurt their life. Right. And people are saving money. And again, it kind of blows my mind that somebody wouldn't do it, honestly, because I can tell you, I'm just doing the things I should be doing, right? I go to see my doctor, I go for screenings, I go for a dental cleaning. I use the app. Yeah, I try to get my steps every day, but it's not consuming my life to get to platinum. And by getting there, I'm saving 15% on my life insurance premium, which is real
Huge.
money, and
Yeah.
getting a bunch of other value. So anyways, I could go on, but
Yeah.
we have a bit of a campaign now called Healthy Outcomes, where we're actually sharing some of the actual data to say this isn't just hey, Tingle thinks this is a better kind of life insurance. There are actual proof points. Now, one, which is one of my favorites, is that policies that have Vitality Plus are a third more likely to place than other policies, which is obviously real value to you and your colleagues and as a carrier.
That's so from Vitality, you guys launched Aspire. And I want to talk a little bit about Aspire and ask you some questions, because I know when we talked last, and I was at the Aspire rollout in New York, and all the fanfare and on Duo and all the other things that were going on, and I get the sense that maybe you were too far out in front of the market. Yeah, I think that the results are not, you're not happy with the results, at least not yet. And why? I mean, it seems so intuitive that anybody who would have diabetes would want to have Aspire on a life insurance policy with Vitality, obviously.
Yeah, well, I'll offer a nice prize to anyone that can tell me why it hasn't gotten better traction. We're studying, and I do have theories. But you're right. I would say that it's the first and only life insurance specifically designed and built bottom up, side to side, for people living with diabetes, of which there are 30-some million Americans. 1.5 million each year are diagnosed, and it's been fine. Our share of sales to people living with diabetes is 2 or 3x the industry as a whole.
Mm-hmm. Yeah.
But we should own this space, and we should be helping. We should be helping our distributors grow tremendously. Some people say, well, most people living with diabetes, this is a horrible generalization, this isn't me saying it, but I hear things like, well, most people living with diabetes aren't in my market. They're sort of middle market or what have you. There are about 4 million of those 30-some million Americans living, 3 to 4 million of those 30-some million Americans living with diabetes that make over $125,000 a year. So it cuts, there are a lot of folks out there that are in your market, our market, living with diabetes. And I can guarantee you, this isn't a Hancock phenomenon, this is an industry phenomenon. People that are living with diabetes and controlling, their A1C levels are being overcharged by our industry. Mm-hmm. For one particular point. With your underwriting expertise, I know you know this, but as an underwriting organization, we get one bite at the apple to take a look at a client. And yes, if they're demonstrating control of their diabetes, they get a better, table or better rate. But the industry is inherently in the embedded pricing assumptions. I can guarantee you that there's inherent conservatism, because you don't know whether in 5 years, 10 years, 15 years, the client still will be. Yeah. But in Aspire, we give the client the opportunity to say, hey, if you're willing to show us that year in and year out, you're maintaining your A1C levels, you can drive your premium down 25%. So it's sort of unprecedented value. Even if you find some carrier that is willing to waive a table and come up with a comparable price, there's all sorts of other value in there through all the things about Vitality that we've talked about, hotel stays and Apple Watches, all this kind of stuff. So we're studying it. We're actually doing a really deep dive on it now, Gonzalo. It's gotten a pretty good to pretty okay response, but we should be bringing lots of new people into the industry, and we should have a much higher share of the sales that are occurring to diabetics today. Yeah,
and when I said you were disappointed with the results, I kind of meant it in the context of, I think you should be owning the space, right? And you probably do as well. And I don't think you're quite there yet. It's a no-brainer. I mean, it really is. But it's also a no-brainer, and I don't want to put you on the spot here, but I asked you permission to ask this question without getting into any details. It certainly has an application for other controllable diseases you can control with exercise and diet and healthy lifestyle. So what other diseases are out there that you think are targets for something like an Aspire, and where do we go from here?
Yeah, it's a great question, because I think broadly the theme, really in commerce in general, but certainly for life insurance, is the future is personalization. Mm-hmm. And even a program like Vitality that tries to help people live longer, healthier lives. Before Aspire, the reality is that we kind of offered the same things to everyone: exercise, nutrition, good night's sleep. The reality is every one of us has a different path to a longer, healthier life. For me, I don't sleep worth a darn. And, my program should, for certain people living with diabetes, we load up points on maintaining A1C levels, really
Right.
focus on that journey. For me, I need a program that really incentivizes me to get my act together on sleep, because that's my biggest problem. So that notion of personalization, Gonzalo, is true. Wouldn't surprise you to know that we're looking at a lot of those different impairments.
Yeah.
You could well see innovation there. It's tricky because a lot of them tend to exist together, right? Obesity tends to be present with certain other things, and hypertension and diabetes. So kind of sorting through what it would look like when somebody may have a couple of those conditions. But you're absolutely right that sort of personalization and focus is likely to come in the future.
I think we have some more to hear from you guys in the future on that, and I'm really looking forward to it. We're getting close to the end here. I do want to make a couple of quick comments. First of all, you guys are open for business on underwriting, and unlike many companies, you're now writing up to age 90, I believe. You've got some controls over age 80. But I mean, you guys have been open for business for a while. I mean, you've pretty much scaled back some of the underwriting restrictions that you had during COVID. So you want to just put that out there because I think it's important?
Yeah, just even during we're not out of COVID, but even during the period of greatest uncertainty early on in COVID, we worked really hard to try to be as open for business as we could. And frankly, we leveraged some phenomenal relationships with our reinsurers. Susan Galili, our chief underwriter, has a ton of credibility. And we were able to pretty quickly figure out where risk really was and where it wasn't, and are very proud of the fact that we were able to, that we didn't have to get too restrictive at any point, and where we did have to peel back a little bit, we were able to open back up pretty quickly, because frankly, we see the opportunity. We want to be able to be there for you and for your clients, and knock on wood, it hasn't bit us at all. It's been kind of remarkable that we've basically been open for business throughout a global pandemic, and not had any adverse outcomes coming out of underwriting during it.
Great. And we thank you for that, because we've had lots of opportunities as a result. I want to make one announcement and maybe just ask you to elaborate on it. We are part of, Agency One is part of a agency-owned and agent-owned reinsurance company called LifeMark Re. I think there was an announcement on LifeMark Re recently. You want to talk about that?
Yeah, well, we're just incredibly excited and honored to be part of it. So that, business you write with Hancock, we've got to roll out sort of products with that integration, but we're starting very soon, and we've committed to LifeMark to participate in LifeMark Re, and I think it's just a wonderful model. As you probably gather from how much I talk about things like vitality, we believe in shared value, and LifeMark Re is a perfect example of that, right? What a wonderful alignment of interests to have those of you that offer John Hancock products to your clients to share in the economic fortunes of that business over time. Yes, get due compensation for having written the business in the first place, but then share in it in a residual manner makes a ton of sense. And I think you can feel good about that, knowing that Hancock's busily investing to try to really shape good mortality outcomes through vitality.
Absolutely.
I think it should be a good deal. And I just love the alignment of interests. We're so excited to be a more prominent part of the platform, and just incredibly excited about it.
Well, we're excited to have you, and I know the rollout is imminent, so we'll look forward to that. I do want to remind everybody that if you have any questions for Brooks or myself, to please put them into the chat box. We're about 5 minutes before the hour, and I think I handled all the questions. There were quite a few comments, all of which were positive about vitality and some other things that we talked about. So.
I see a few questions here, Gonzalo. I don't know if you can see them. I see
Gonzalo, there are questions in the Q&A. Can you access the Q&A?
The answer is no, Kathy. You want to help me with the Q&A, because I was seeing all the chat stuff, so I wasn't seeing the questions. My apologies.
Sure, absolutely. This was interesting, Brooks, from Anthony. Anthony wants to know what keeps you up at night. It's interesting. That made me laugh. He thinks that a sharp rise in interest rates versus a steady, slow rise would hurt the insurance industry. And then he's also asking if John Hancock has created a COVID marketing piece that addresses your comments on how few COVID deaths actually had life insurance to leave to their loved ones?
Yeah, what a great couple of questions, Anthony. First of all, to know before I even said it that I don't sleep well at night, but you're right. You know, we talk. It's a funny industry sometimes. We talk about how low interest rates are hard for our industry, but it's a very astute question. It's not the inverse, that if interest rates were to like spike overnight, that would be painful too. So it's a little bit of a Goldilocks thing where a nice sort of orderly uptick over a period of time would be beneficial to the industry. So, you know, I think in terms of keeping, and no, we haven't done any particular marketing pieces on COVID. We should really think about that with, you know, particularly with our unique response to it in terms of vitality. You know, I guess I just worry for the industry as a whole. I think we all have to be, we have to be innovating at a faster pace. I mean, I love our industry. I've grown up in our industry. It's an industry we should be very proud of, but you'd have to be the biggest optimist or the most charitable person to describe our industry as having been highly innovative. And I'm very proud of what we've done over the past few years at Hancock. And we're trying to bring that same innovation to the buying process now with electronic health records and digital apps and things like that. But I really want to see the whole industry. This notion of a life insurance company helping people live longer, healthier lives is something I completely believe in. I actually have an opportunity. I'm testifying before a congressional hearing in a couple of weeks about that and how I think that the life insurance industry should have a seat at the table trying to promote longevity of Americans. And I really think every company should be offering you and your clients something like vitality. You can love or hate vitality, but you can't disagree with the premise that your life insurance company should want you to live a long, healthier life. So I think it keeps me up at night is not so much a concern for Hancock, but more just, I hope our industry can innovate and bring digital part of it. I mean, you think about the world that your customers and that we all live in today. Everything is digital. Everything is engaging. We've got smart appliances. Some of you may drive a smart car. Even something that's not a Tesla has like 450 sensors in it now. We've all got, you know, 4 or 5 smart devices of one kind or another. We just can't continue to sell a stack of paper. And I know it's more than that. It's your advice and your support. But so I just worry that our industry isn't innovating fast enough to kind of succeed in a modern digital economy.
Thank you, Brooks. Another question that came in from Ham, which is, could Brooks comment on the new 7702 rule and when he expects John Hancock to release products that incorporate this change?
Yeah, first of all, a tricky one. I was just in a set of meetings on that yesterday. We do have our first products coming to market. Gosh, sorry, Gonzalo, you know, Wayne or somebody from my team can get you the specific dates. It's coming soon. We have our first couple of products incorporating that. And it's tricky because, and it sounds like you've had webinars on it in the past. You guys know the dynamic. Like, you know, our view is that, you know, the job of the advisor didn't suddenly get easier, right? So when you look at the impact it's having on targets in some cases, and you know, the potential effect of lowered comp is not something we want to have as an outcome. We don't believe everyone on this call's job suddenly got easier and you should be paid less. But it's tricky in the product design. So I won't get ahead of myself in terms of what we're trying to do, but we are trying to kind of optimize that within these changes. So first couple of products are coming very soon. I'm sorry, Ham, I don't have the exact time frame, but coming soon.
We will get more information on that out to people as soon as we know. And I mean, you know, Brooks, there's probably a whole lot going on inside the walls of Hancock on that issue. And, you know, I'll let Kathy keep asking some questions here. But we'll get back to that, Ham, on offline.
Yeah, thank you, Brooks. I do not see any more questions, and we are at the top of the hour. So with that, I am going to thank you, Brooks and Gonzalo. That was terrific. For folks that want to learn more about LifeMark Re and John Hancock's participation in the program, please reach out to me or to Gonzalo or to Dennis or to Ed, and we'll be happy to explain what the program is in further detail and how it's available to our Agency 100 advisors. So what's next? On Thursday, April 15th at 3 o'clock Eastern Time, we're going to be hosting a webinar on the wealth transfer tax tsunami with Joe Ross, Vice President for Sales and Productivity and Business Development with AIG Financial Distributors. Everyone is talking about taxes, but did you realize that there are 3 things the Biden administration would like to do, and if they succeed, it could cause a wealth transfer tax tsunami? Find out what those 3 things are and how you can combat their effects with life insurance. Please mark your calendars for April 15th at 3 o'clock Eastern Time for this not to be missed session. Invitations will be going out next week. These are my closing announcements for today. Again, I'd like to thank Brooks and Gonzalo. If you have any questions or would like additional information, please reach out to myself, Gonzalo, Ed, or Dennis. Thank you for joining us. This
Brooks,
concludes
thank
the
you so
webinar.
much.
Thank you.
Thank you so much for being with us. Appreciate it. All the best.
Bye.
Thank you, everyone. Bye-bye.